What is going on, everybody? Welcome to video number 4 of the Forex Beginner Boot Camp series. This video, we're going to cover a lot of your Forex basics, from learning how to read a currency pair, the type of positions you can take, and then, lot sizes and volume, and just knowing everything of how you make money in Forex and trading. So first off, you all, I want to, get it out the way that there is only two type of positions that you can take. No matter how complex Forex and trading may seem, at the end of the day, you can only do two things. You can either buy or you can sell. Now, when you buy, you are saying price will go up. And when you sell, you are saying price is going to go down. It's that simple, you all. When you buy, price is going up. When you sell, price is going to go down. Let's switch over to one of my live trading account. It's actually my only trading account at the moment. We are looking at my live trading account. We're looking at, as you can see at the top, is using Forex.com, U.S. regulated broker. We're going to go over that as well later. I sold. Let me zoom in so you all can probably see it a little better. We're looking at Euro Yen. And on Euro Yen, you can see that you see how it says sell 0.75. That means I sold up here where the line is at, which means I thought price was going to go down. And as you can see, price did go down. It's a trade that I'm still in. I am holding this trade. I'm currently in profit. And why am I in profit? I am in profit because I sold. Remember, you can only buy or sell. You buy when you think price is going to go up. You sell when you think price is going to go down. So because I sold and price went down, it's currently down, I am up. I am in profit. I am making money. Now let's just say if I sold up here and when price went up, guess what? I was losing money. But because I sold and price is currently down below where I sold at, I am in profit and I am making money. Switch back to trading view. So remember, you all, no matter how complex trading is, you can either buy or you can either sell. Price is either going to go up or price is going to go down. It's that simple. Next, let's talk about base and quote. So when you are looking at a currency pair, for example, we're looking at the GBP versus the USD, which is the Great Britain pound versus the US dollar. The first currency is always going to be the base pair. So in this example of GBP versus the USD, pound versus the US dollar, GBP, the Great Britain pound, is your base pair. The second currency is always going to be your quote pair. So for example, the US dollar is going to be your quote pair. For example, who was looking at the euro dollar, euro versus the US dollar. Euro is your base pair and the dollar is your quote pair. So just remember that very simple stuff, you all, base versus quote. For example, and just some economics behind it. 1 pound can be exchanged for whatever the current price is. So your base pair, you're going to be exchanging it for the current price. So for example, 1 pound is equivalent to where price is at right now. Price is at 1. You see where I'm at, my arrow, the green is where price is currently at. So 1 pound is equivalent to approximately $1.30 of the US dollar. So the pound is worth more. The pound is worth more than the US dollar. So for example, if you was to travel to the United Kingdom, where they use pounds, and you was to exchange your US money to get some Great Britain pounds, you would actually lose money. You'll lose money because the pound is worth more than the dollar right now. So just basic knowledge of base and quote pairs. And then just remember from the last lesson, what is Forex? Forex is the foreign exchange market. So it's just, the exchange of money. So the price and values is always going to go up and always going to go down. Next, we're looking at pips. So you're going to hear this terminology a lot. People talk about, I made 100 pips, I made 10 pips, I just caught 100 pips on this trade. Pips is the unit of measurement to express the change in value between two currencies. So if you look at the right hand corner of your chart, you're going to see a lot of numbers. The pip is usually the fourth decimal or the last decimal. Mathematical purposes, examples. If you look at, for example, if the pound US dollar went from 1.32 thousand to 1.33 thousand, price went up 100 pips. If price went from 1.32 thousand to 1.31 thousand, price went down 100 pips. So for example, let's just go over here to the right, and when you look at 1.31400 to 1.31600, this right here, you all, that is 20 pips. We can even get out our pip calculator from here to here. That is 20 pips, you all. So simple terms, the price to go from 1.31800 to 1.31900, price went up 10 pips. If price go from 1.31800 to 1.31700, price went down 10 pips. You all will go back over here. You look at right here where my arrow is. If price go from 1.3800 to 1.31 even handle, price just went up 20 pips. Now, pips don't really do no good if you don't have any value or money on it. So next, let's look at lots. Lots equal the number of currency units you will either buy or sell, deal with volume. So for example, one standard equal 100,000 units. One mini, it's a mini lot, equals 10,000 units. One micro equals 1,000 units. Now, this is how you usually look in a lot of your trading platforms. 1.00 equals a standard lot. 1.10 equals a mini lot. 0.01 equal a micro lot. Now, here comes the money aspect of it, you all. Now, depending on the pair, but typically 1.00, which is a standard lot, usually equates to about $10 per pip move. 0.10 equals about $1 per pip move, and 0.01 usually pays out 1 cent per pip move. So for example, if John buy GBP USD with the standard lot, remember a standard lot is going to pay out $10 per pip move, and price goes up 10 pips. Remember, if you buy, you think price is going to go up. So he bought, price went up, and it went up 10 pips. So that means he profited $100 on this trade. Let's go back to my live trading account right now. Real action. Looking at Euro Yen. I sold, and price went down. Now I sold with a 0.75, which is, let's go back. I sold with 0.75, you all, basic math. So if I sold at 0.75, that is 75,000 units. Why is it 75,000 units? Basic math, you all. If a standard is 100,000 units, a mini is 10,000 units. So what is a standard, you all? A standard is 1.00. A mini lot is 0.10. And I sold with a 0.75. So it's not quite a standard lot, more than a mini lot. It is 75,000 units, and it pays out approximately $7.50 per pip. Look more, a little less, as we're dealing with the yen. So, and remember, prices currently, I am currently up about close to 20 pips on this trade. So that means I'm up somewhere approximately $145 or so. Let's look at it. I sold up here. Yep. So remember, gotta learn this. Even if you gotta watch this over and over a few times to get it in your head and just to get the math, just the basic mathematics behind it. But a lot is just the number of currency units you buy, sell, got to do with your money. Let's jump back to the live trading account before we leave this topic, and I can show you all. Like if you go up here to new order, as if I was to execute a new order. Remember up here with your value, your value can be whatever you want it to be. Now you gotta have enough money in your account to cover that value. We're gonna talk about leverage next. But let's just say if I did want to enter with a standard lot size, I'll put 1.00. Remember, 1.00 equal a standard lot, which is 100,000 units, which pays out $10 per pip, you all. And if I thought price was going to go down, I would sell. If I thought price was going to go up, I will buy. You notice there's only two options. You can either sell or you can buy. You can either buy or you can sell. There is no third option. You can buy or you can sell. That's how simple trading is. Now there's some sell limits, buy limits, sell stops, buy stops, but you can only sell and you can only buy, you all. That's really how simple trading is, no matter how complex it seems. Now there's a lot of different trading strategies and ways to figure out if you want to buy or sell, but it's as simple as either buying or selling. Real life example, I sold, I thought price was going to go down. I am up, I am making money on this trade because price is below where I sold at. Next, let's talk about some U.S. regulated brokers. I am not a fan of using offshore brokers. Just be aware of people that try to get you to use offshore brokers, non-regulated brokers. Because I don't feel comfortable with my money in an offshore account, non-regulated broker. You can do your research on your own, do a lot of due diligence. But you will see there's a lot of stories about money coming up missing in offshore brokerage accounts. And quite frankly, if you're trading with a significant amount of money, you just want to know that your money is safe, especially when you are trading. So I definitely recommend using U.S. regulated brokers. There are two U.S. regulated brokers. The top two U.S. regulated brokers is Forex.com and Oanda. TD Ameritrade is also another U.S. Regulated Forex broker. Forex.com is the one that I personally use. It's the biggest FX broker in the United States and amazing customer service. I don't get paid for you all using Forex.com or anything. You can use whatever broker you want to use, but I just definitely recommend that you use a U.S. regulated broker. Real simple to set up a trading account. You just come to open an account. You can decide if usually go to standard account if you're just getting started. But you can do a live account. Live account is just when you are trading real money. Or you can do a demo account. I highly recommend if you are new to trading, or even if you're not new to trading, but you're not a profitable trader, I suggest opening up a demo account so that you can practice with fake money. Because guess what, you all? If you can't make money with fake money, you're not going to be able to make money on a real account. So I don't suggest starting off going straight to a live account, straight to a real account. Um, you don't really know what you're doing, or if you're new, and because you're going to end up losing your money 95% of the time. You might luck up and win one or two trades, but eventually, if you keep trading, you're probably going to lose all of your money. It's going to give you a bad first impression of trading in Forex. So let's jump back to my real live trading account. I got a Forex.com broker, and you can see that this is a live account. Live account means it is real account. It is real money. But it's simple. You just go to Forex.com, or you could go to Oanda, click open an account. It's very simple. You even open up a live trading account, which is real money, or you can do demo. If you got like an LLC, like for example, I have an LLC, so I have a corporate trading account. Using of course real money. Get into leverage, you all. Leverage. U.S. regulated brokers offer a 50-to-1 leverage. So for example, if you have $100 in your trading account, you can control up to $5,000 of buying power. If you have $1,000 in your trading account, that means you can control up to $50,000 worth of buying power. If you have $10,000 in your trading account, you can control up to $500,000 worth of buying power. Leverage is amazing. If you use it correctly, there's a lot of opportunities to make a lot of money. But also the flip side of leverage, a lot of people abuse it. You can lose a lot of money quickly with leverage. Definitely you want to use great risk management. We're going to talk about that in one of the later videos. Risk management is key, but that is what leverage is, you all. Leverage is amazing. U.S. regulated brokers give you 50-to-1 leverage, which in my opinion is more than enough, and you never really want to maximize the leverage that is given to you. Because it's just not safe and it's real risky, and that is not how you become a profitable, consistent trader. Remember the goal, you all, as you are, starting your trading career. If you have not already started, the goal is not to win one trade or two trades. The goal is to be profitable month in, month out. Not even month in, month out. I judge my trading performance by quarter, which is, after every 3 months, Q1, Q2, Q3, Q4, I like to judge my trading performance. And I want to see consistency. I don't care about one trade, two trades, 5 trades. I want to see consistency month in, month out, year in and year out. So doing that, you're not going to maximize your leverage. You want to stay safe. But that's about it for Forex Basics. There's some other stuff like margin. You all, margin is just pretty much a deposit out of your trading account when you are trading. A lot of stuff. Of course, continue to read up on stuff as well. This video is to kind of really put it out there in your face. Basic stuff that you need to know, like the back of your hand, before you even think about making money in the markets. Very, good stuff. Go back to the live trading account. Just show you all again. Sell. Price went down when price was above where I sold right now. I would have lost money. But just basic stuff. So in the next video, you all, we're going to cover a lot of good stuff. Of how to identify profitable trade setups, different types of trends. We're going to be talking about support, resistance, supply, demand, how to read candlesticks, candlestick patterns. A lot of good stuff in the next video that when you put all this stuff together, you're going to have a good knowledge, a good foundation that will help you start your trading career, and then to even know if trading is for you. So that's what this series is about, just to kind of give you that foundation, enough knowledge to where you know if trading is for you or not. And if it is for you, it's enough knowledge to see if you want to pursue even more advanced education, because it don't stop after this, you all. But see you all in the next video, where we will go over technical analysis, which is price action, and how to read a chart. See you in video number 5.